Good afternoon. Welcome all to the Coface webinar. Today, our senior economist, Carlos Casanova, will take us through to our 15 minutes to 30 minutes analysis, helping us to anticipate risk and identify opportunities in 2019 so that you can get prepared before the market catches you. Carlos is a regular contributor to media like CNBC, Bloomberg TV, as well as Financial Times. After the presentation, we will open the forum. In order to minimize the noises and echo, the call is now muted, but you can raise your questions at the chat box. Last but not least, don't forget to give us your thoughts on a 2-minute survey. So first, allow us to put things into context. Why is Coface so into risk analysis? As the world's top 3 trade credit insurer, some 3 million names across 200 countries pass over 520 billion euro of credit risk to us every day. So, Carlos, the world seems to be quite shaky. Oil prices tumbling, stock markets worldwide are weak, and the trade war seems to be in its full stream. So how worried should we be? Are there hopes?
Thank you so much for that great introduction, Patience. Thanks so much to our participants on the phone. I hope you can hear me well. My name is Carlos Casanova, and I'm the economist for Asia Pacific. We cover 26 countries and 13 sectors in the region, and today's risk webinar will focus on our outlook for the economy in Asia in 2019. As my colleague rightly mentioned, there are a series of factors that have started to impact the mood going forward. Chief amongst which is an impending trade war between the US and China. And all of these factors have come together and have really set the tone for a deterioration in global sentiment. And so I will start by discussing that before we move on to specifics in China and Asia. Why do I say that the mood has started to deteriorate? What you can see in this chart is our map with all of our country risk assessments. These country risk assessments are a measure of credit risk, so they are slightly different to what you would expect from a credit agency such as Fitch, Moody's, or S&P, in the sense that we are not identifying sovereign risk. What we are looking at here predominantly is the risk that a company in a specific geography will not pay or default on its payments. The mood has started to deteriorate. To put this into context, in 2017, globally, we upgraded about 60% of the times and only downgraded about 40% of the time. 2017 was a very good year. We experienced global synchronized growth, both in Asia and in other parts of the world, amongst developed and emerging markets. And there was an upswing in commodity prices, which helped to support this pickup in activity in that year. Going into 2018, what we have seen is a decoupling of these conditions, and that's translated into 60% downgrades versus 40% upgrades in the year. For Asia, the divergence is even more pronounced. This year so far, we have downgraded 75% of the times, and we have upgraded to 25% of the times. The latest downgrade was, as you can see here, Pakistan, and that was done in the third quarter of 2018. We also cover sectors, another important part of our research, because of course we do have our hands in a number of fields at any given point in time. Our sector assessments are based, of course, on economic data, payment trends, our inputs from our underwriters, as well as 4 key financials, including turnover, profitability, the net debt ratio, and cash flow. And the situation, at least for Asia in the third quarter, remains a little bit more stable. However, we did downgrade a number of sectors, including ICT, in earlier quarters in the year for a series of reasons that we shall cover in the following slides. So moving on to China, I want to start by discussing some of our proprietary data before we move on to the macroeconomics. Payment trends in China are worsening, and we expect further deterioration in some sectors. What you are looking at here is an indicator that we call ultra-long payment delays. So these are payment delays that exceed 180 days from the date of invoice. In other words, if you have made a sale and the terms on your invoice are 30 days, these would be delays exceeding 30 days plus 180 days. And the proportion of companies in China that experience these delays increased from around 11% in 2016 to 21% in 2017. This is an annual survey, so it's our own proprietary data, where we reach out to approximately 3,000 companies in Asia, 1,000 of which are located in China. So there's definitely a worsening in terms of payment delays. Here, a lot of the times, the same as with debt, we like to relate that to something that is more tangible. Debt is usually described in terms of GDP. For payment delays, or ultra-long payment delays, we like to compare those to total annual turnover. According to our international experience, when 80% of the time, these ultra-long payment delays don't get paid at all. So you can imagine if you have a sizable proportion of your annual turnover that is tied into these ultra-long payment delays, you might stumble into cash flow risk. So this is essentially a clear indicator of cash flow risks. Some sectors historically perform worse than others in China. In particular, we can see how the energy, construction, automotive, and agro-food sectors didn't perform very well, with there being a high proportion of respondents that experienced ultra-long payment delays exceeding 10% of their total annual turnover. Now, we do like to contrast the data of the survey with data from listed companies, and you can see here on the right, we've downloaded financials for 3,000 listed companies in China and compared the results, and they're quite similar to what our payment survey is saying. So energy, large proportion of firms with EBITDA over interest expense over 1. That means that about 30% of listed energy firms in China don't have earnings that are big enough to cover their interest expense or the cost of servicing their debt. This is a situation that is very typical of zombie enterprises. Of course, in the energy sector, a lot of these firms are state-owned and have access to financing to roll over this debt. But the real estate was the second sector, in line with what a survey is saying with construction. And that's an area where the risks might be slightly higher, given that a lot of these companies are very leveraged, but also privately owned. Consumer staples, of course, are very closely related to agri-food and consumer discretionary to automotive. Going forwards, remember this is a survey that was done in the end of 2017, so we're looking predominantly at a deterioration in payment trends in 2017. We are currently doing our survey for this year, and we do expect some deteriorations in certain sectors, some improvements in other sectors. The good news is that a lot of energy companies have benefited from higher oil prices throughout the first 9 months of the year. Metals were also performing better than anticipated, and so has the chemical sector. However, we do expect a big decline to come in from the ICT sector, as some of the companies struggle from uncertainty surrounding the trade war, the auto sector, and also the agri-food sector. So we do foresee some of these sectors to perform a little bit worse into the coming months. So what is driving this deterioration in payment trends in China? China is undergoing a structural slowdown, and this slowdown is predominantly related to the need to reduce or clear some of the systemic sources of vulnerability within the economy. Now, I'm going to focus on two main sources of vulnerability, the housing bubble and the credit bubble. On the left, you can see that housing price growth, the line in blue, has actually declined quite significantly and is stable around 0%. So the authorities have already been very proactive in managing the risks of a housing bubble. But of course, whereas the Chinese economy was characterized by strong housing growth, the sector accounts directly and indirectly for 30% of GDP, so it adds a lot to growth at the end of the year. This is a growth engine that they will not be able to rely upon going forward, and that is translating into slightly slower growth momentum. Last year, we saw very good performance, of course, but this was predominantly credit-led. So the line in green is total source of financing, which represents the amount of liquidity in the economy. And this line actually started to decline quite significantly in the first half of 2018 as authorities focused a lot on reducing corporate debt. So by reducing the amount of cash in the economy, they have effectively nudged companies to deleverage, and we will see that in a slide later on, and how that's translated into deleveraging in different parts of the economy. But of course, this structural slowdown, which is also linked to China's desire to move its growth model away from investment and towards more domestic consumption, has led to a decline in key activity indicators, predominantly industrial production, the line in green, but also fixed asset investments, which were very, very slow in the first half of the year. And given that the Chinese economy is now investment-led, they account for about 50 or 60% of GDP, it's no surprise that this has led to slower growth, and a lot of companies are starting to feel that. There is, of course, one other source of risk, and that is export growth. Now, exports only account for 20% of China's GDP, but it is a good and welcome tailwind to have in times when other growth engines are starting to run out of steam. 2017 was a very good year, and we have started to see a structural slowdown in exports in 2018. This cyclical slowdown, I apologize, is related to a number of factors, including there being a high base effect because we are comparing 2018 with 2017. Commodity prices have performed in a mixed manner this year. 2017 was, in general, a very good year for most commodity prices. 2018, we've seen a pickup in oil and iron, but not all metals have performed as well. So a little bit of a mixed performance there, also dragging on export growth. And of course, there's no longer global synchronized growth, so we have seen a decline in demand, especially coming out of Europe. Now, there's another big factor that needs to be taken into account, and that is the trade war. So the trade war will definitely not help, given that the exports are already experiencing a cyclical downturn. Now, there's a little discrepancy in what I'm saying and what you can see in the data, because the blue line for China actually picked up towards the latter months of the year, but that is predominantly related with a front loading of exports ahead of the implementation of tariffs by the US administration. So in line with a slowdown in global trade, in line with the cyclical factors as I mentioned earlier, and in line with the trends that we are observing for Asia, the line in green, we expect that export growth for China will continue to decline in 2019 in particular, as the trade war begins to bite. Moving on to the next slide, which is slide 10. Why do we say that a trade war will be felt in 2019? Well, of course, it will still take a few months for the front loading of exports to come down. A lot of the times, contracts with suppliers are a little bit sticky, or it takes time to find an alternative source for supplies. So we do not expect this front loading to fall off a cliff in 1 or 2 months, but it is something that will start to taper going forward, and definitely into 2019. There are also secondary impacts to the trade war, so investor confidence could translate into further declines in investment going forward. But also the fact that a lot of sectors will actually be impacted by this trade war means that there should be a slowdown in demand across the board for China. We have about 50% of goods that are intermediate goods, which also points to the fact that a lot of these products are part of global value chains. And so the impact of a trade war between China and the US will be felt not only in China and amongst a wide range of sectors in China, but also in some economies in some other economies in the region. Now, all of the points that were mentioned earlier, the fact that the government has focused on tightening liquidity, the fact that the economy is slowing down, and the fact that there are also some external headwinds on the export front, are actually affecting a group of companies that are not often referenced in the media or in research for that matter, and that is small and medium enterprises, SMEs. So on slide 11, you can see some charts of our soon-to-be published report on SME financing in China. So on the left-hand side, you'll see leverage ratio, and we've broken that for SOEs and private enterprises. And you can see that part of that goal to reduce leverage in the first half of the year was to promote more lending to productive sectors of the economy, many of which are dominated by private enterprises. So one would have thought that as part of that deleveraging campaign, that more financing would go to SMEs. But this is not so easy, and it definitely has not been the case in the first half of 2018. As you can see on the right, SME loan growth stalled faster than loan growth to large enterprises. And in fact, they only account for approximately 20% of total loans as opposed to about 33% during the same period last year. So SMEs have struggled to access conventional sources of financing as a result of the policy shift in the first half of the year towards a tighter monetary policy stance. Now, there's another critical factor, which is the fact that this tightening in credit conditions was predominantly focused around shadow banking products. SMEs are typically not well serviced by the state-owned banks. This is, of course, a situation that is not unique to China. Many emerging markets and developed markets tend to be in a similar situation, where risk underwriting procedures for many banks tend to favor big clients with robust credit credentials. It's just easier to loan to big companies. And so the fact that China has actually intervened to reduce shadow banking means that SMEs have been even further squeezed. They account for a very sizable portion of output, about 80% of total urban employment in the country. So potential spillovers, in case there is stress in the SME sector, are quite huge for the Chinese economy, and it's something that we should continue to monitor going forward. Of course, it's unlikely that the central government will not respond to some of the threats that we have identified. And in fact, they have started to do so. The impact of, according to our calculations, the impact of 25% tariffs on all of China's exports to the US, assuming that Trump goes ahead with his threat to impose such tariffs on all of China's exports to the US, would equate to about 1% of GDP, and that's assuming a very conservative export elasticity, so there is some upside risk to that assessment. And while this is not a negligible impact, it is manageable given the right policy response, and especially in the context of an economy like China. A few things have happened already. The policy has tilted from being contractionary to being more expansionary, and we've seen that predominantly through targeted cuts, targeted reserve requirement ratio cuts for small and medium enterprises. The liquidity that was freed as a result of these cuts, there was a guidance circulated amongst banks, was supposed to be used predominantly to do debt equity swaps and also to loan more to SMEs, but of course, in practice, this may not always be the case. So they've also moved on to lowering the interbank rate to try to alleviate the cost of accessing financing and servicing debt in the context of there being headwinds. But this might not be enough because, as you know, when conditions become tighter, banks don't loan to SMEs. When conditions are loose, banks don't loan to SMEs either. So more needs to be done on the policy front. So we do expect that the authorities will focus on increasing productive aspects of shadow banking, so they move away from wealth management products and the issuance of LGVFs for infrastructure projects that are not productive, but they will continue to allow other types of financial intermediation that benefit the private sector of the economy. And also, we can't exclude the possibility for the authorities to actually experiment a little bit more with that interest rate liberalization to enable banks to actually price in the appropriate risks and lend more to SMEs. Moving on to slide 13, we continue to discuss Asia. So our payment surveys are pointing to a steep deterioration of risk in China and throughout the region as a whole. So 63% of companies in Asia experience payment delays, and that is despite there being global economic improvement in 2017. However, this impact is not spread equally. So there's countries such as India and Japan that have experienced a high proportion of payment delays last year as well. And in particular, in India, we've seen a deterioration of conditions that led us to downgrade the country in the second quarter. So this is by no means only a situation that's impacting China. We also have to be aware and mindful of risks in other parts of Asia. Cash flows have been impacted by increasing oil prices, although there's been some volatility in recent weeks regarding oil prices and how those will pan out going forward. Higher interest rates in the US have drained liquidity out of emerging markets, and we will discuss that in the following slide. And that is, of course, creating some problems for the region. And developing trade war risks will impact both demand and profit margins over the 2019 to 2020 period. This pressure is already started to materialize, and we can see on slide 15 that there are signs of both an export slowdown and also activity slowdown as a result of these trade war rules. PMIs, we are comparing here the level in January this year, which is after that very good period in 2017, with October 2018, and we can see that there are very broad, very significant declines in a series of countries in Asia, led by China, Malaysia, Taiwan, a very big decline in the PMI, manufacturing PMI for Taiwan and Thailand. But again, we have a decoupling of conditions globally, and the same applies for Asia. Some countries have actually witnessed an improvement in their PMIs, led by Vietnam, Philippines, and India. In addition to there being trade war risks, we see that tighter global liquidity or central bank liquidity has started to translate into outflows from the region. Net portfolio outflows in particular were biggest for India and Malaysia. And that's also led to steep depreciation in the currency, which in the short term can be beneficial for large exporters because it improves the terms of trade, but it can lead to capital outflows. And for countries that have some debt risk or external financing needs, then that can result in a balance of payments crisis, as we have seen in a few cases in Asia this year. So it's a situation that is quite worrying. As a result, a lot of these countries have actually gone ahead and implemented rate hikes that are counter-cyclical because the economies are, in most cases, growing better than they were a few years ago, but they're still growing below potential. Those rate hikes were led by Indonesia and the Philippines. They've hiked 150 bips in the first 10 months of this year, and then India with 75 bips and Malaysia with 25 bips. That has definitely helped to stabilize some of their currencies, and not all central banks are focusing on the same things. So some central banks target inflation, other central banks target currency stability. So not all central banks focus on the same things, but also not all economies will continue to feel the squeeze as much going forward. Whether or not countries will continue to struggle with outflows in 2019, and our general view is that markets have perhaps gotten ahead of themselves slightly when it comes to outflows from the region, but there are some pockets of stress that we need to understand. And these will depend on things like how large the government debt level is for the country, how big their external financing needs are, whether the economy has a budget deficit or a surplus, and if that's going to continue to deteriorate in 2018, the interlink between the current account deficit and increasing oil prices, and as well as how many buffers these economies have in order to face the outflows. So things like FX reserves, and also how big that external debt is in relation to FX reserves. It's a broad range of factors, so to make your life easier, what we have done is we've compiled an index that looks at all of these indicators, and we've used a data reduction technique, which for those of you that like statistics is called a principal component analysis. And we've put this together and we've shown you a picture that uses just one dimension in the data to show the spread. And there are definitely countries that will struggle more than others. On the left-hand side, you shall see that Sri Lanka, Pakistan, and India are both large economies in Asia where we do have exposure, but are also going to continue to face risks. All three economies were actually downgraded throughout this year as a result of there being a deterioration in growth and an increase in that pressure led by higher oil prices. And a lot of these countries, India is a great example, being net importers of oil. We expect that the situation will not improve overnight, and that will potentially lead to more pressure in those areas. But on the other hand, we have places such as Philippines, Indonesia, and Thailand on the right-hand side that have experienced outflows and depreciation, but they are in a much better position to withstand this pressure going forward, and that is in many cases related to the fact that the economies learned their lessons from the Asian financial crisis in 1987 and have built very robust buffers over the years, which include FX reserves that cover about 8 months of imports in the case of the Philippines, or 4 months of imports in the case of Thailand. So definitely a discrepancy in terms of risks going forward, and we do expect that to also influence our country risk assessments. I will finish with this slide before I move on to the Q&A. But in Coface, I purposefully didn't mention too much about our country risk assessments because I wanted to leave this to the end. We try to assess risks in a very proactive manner, and we try to move the needle on economies before we actually see, big news stories coming out. So as a result of this deterioration this year, we implemented a series of cuts in India, Sri Lanka, and then in the third quarter for Pakistan. That was predominantly as a result of that balance of payment situation that we identified earlier, and the tools that we are using so far to identify the risk points towards the continuation of those. But we have upgraded other economies such as Malaysia. That was a result of the election process in the country and there being strong growth momentum for many, many quarters. And of course, Malaysia is benefiting from higher oil prices, so they can afford to be a bit more expansionary on the fiscal front. And the fact that they can afford to be more expansionary means that they were able to cancel a global sales tax that was highly unpopular amongst the Malays, but also move to reinstate fuel subsidies to buffer some of the impact of higher oil prices. So together that's kept inflation quite low, and there's room for, on the monetary policy side, for things to continue to remain accommodative, at least in the first half of 2019. So we do see some better growth momentum for Malaysia, and so we decided to act upon that already in the second quarter. So we are seeing a mixed picture. Nonetheless, we do have to be cautious about risks in certain countries. Thank you so much, and feel free to ask questions through the chat.
Thank you so much, Carlos. Now, I'm not sure about you, but for me, it's a lot more clarity into different pockets of risk and opportunity and how things are being interlinked. The first question has come in. This is on Will the China slowdown have a domino effect on other Asian countries? And which country will be more exposed than the others?
Thanks. That is a great question. So, of course, the slowdown in the Chinese economy will have impacts on other countries in Asia, and I think I did allude to this in my presentation, but maybe I should have gone into more detail. The impact on other emerging markets will come in two ways. One is directly through supply chain links. So as we saw in a few slides earlier, about 50% of all products targeted by the US are intermediate goods, which means that they are exported from China to the US and then processed and then exported to other parts of the world. They're part of a global value chain, and there are two important global value chains that are being targeted. That is the ICT, where we also put in machinery, and the auto supply chain. And further upstream, a lot of countries in Asia have exposure to China through these two value chains. So of course, if there's a deceleration in demand for Chinese intermediate goods, that means that Taiwanese, South Korean, and Malaysian exporters of intermediate goods up the supply chain will also experience a squeeze. Their second channel is through Chinese demand. So China is a big market in Asia, and for a lot of countries, it is their largest export market. So even if they're not directly linked through supply chain links, they might experience a decline in demand from China for other goods, like, for example, agro-food goods, including fish from Vietnam, or mangoes from the Philippines, or other manufactured goods from places such as South Korea and Japan. So there's two main channels through which countries will be affected, and we expect that those three economies on the supply chain front will be the strongest, and Philippines, Taiwan, and South Korea could also be impacted just on the pure demand front.
I see. So for the slowdown unrelated to the trade war, will the trade war make things worse?
So, yeah, that's another good question. So for sure, we have seen a slowdown in Chinese activity that translated into a GDP growth rate of 6.5% in the third quarter, which is the lowest that it's been for a while. So we are seeing a slowdown, and of course, the media is very quick in identifying that this is linked to the trade war. But as we saw, exports have actually performed fairly well despite there being significant headwinds, and that's a result of a lot of agents front-loading, being proactive, and actually exporting more before the tariffs fall in place. So far, that lower figure in Q3 is not reflecting a decline in exports, because exports performed very well. It will start to show as this front-loading fades into the second quarter, and we expect that it might shave off up to 1% of GDP, but of course, that doesn't include in a Chinese response. So it's a business as usual continuation of that slow and gradual decline in Chinese growth.
Excellent. No wonder we always say that never act on news headlines. So finally, we've got another question. It's on oil price. It seems it's stumbling and officially declining to the bear market. How will this impact Asia?
So that's a good question as well. Oil prices were, of course, a big story throughout 2018. They've increased quite significantly, and in the last few weeks, we've seen a bit of a bear market materializing around oil prices, with them falling to almost $60 or even below $60 per barrel in the last week. This deterioration in sentiment that led to the market is related to the fact that the embargo to Iran was met with some very notable exceptions, including exceptions to China, which is, of course, Iran's largest energy buyer. So that led to a shift in investor positions, and we've seen that long oil positions declined by the most since 2016. So there's been a bit of a shift in terms of oil expectations. However, the two big countries that tend to have significant pricing power on oil markets, including Saudi and Russia, are not as coordinated this time around as they have been in the past. So it's not granted that Saudi Arabia will continue to increase and will not agree to a production cut in the next OPEC meeting, which will, by the way, be very interesting to follow. Overall, if we have a slowdown in oil prices, that might benefit countries such as India, which are net oil importers, and Indonesia. But in Malaysia, we've factored in a recovery in oil prices, and that's going to allow them to be more expansionary on the fiscal front. So if that does turn around, then countries that are net oil exporters will have to think twice about how they conduct policies in 2018. And just one final word on oil prices. Our assessment remains unchanged. So we expect oil prices to stabilize. There will be some volatility, but they will stabilize around $70 per barrel in 2019.
Excellent. Thank you so much, Carlos. Our advice to the audience is don't take risk lightly. Stay informed. We have made it easier for you. Just subscribe to Coface Economic Insights. And we would appreciate a lot if you can give us 2 minutes on how you think about this webinar. You would have the presentation as well as the recording sent to your mailbox soon after today. Thank you, everyone. Have a good afternoon.